Have you ever looked at the stock market and just thought, what is going on here? Why are some stocks soaring while others that seem perfectly fine are just stuck? Well, today we're going to pull back the curtain on something called factor investing. Now I know that sounds super technical, maybe even a little intimidating. But trust me, it's a powerful way to understand the hidden forces that really drive long-term returns. And the best part? You're probably already using these exact same ideas in your day-to-day life without even knowing it. Okay, let's get into it. Seriously, think about it for a second. The way you make decisions, how you hunt for a bargain, how you pick a new show to binge watch, or even how you choose something as practical as a new set of tires, those instincts, that logic, that is the exact same thinking used in some of the most sophisticated investment strategies on Wall Street. You already have the skills. So let's take a look at how to translate that everyday expertise into your investment portfolio.
Okay, first up, let's talk shopping. You're walking through a store and you see that jacket you've been eyeing, but it's suddenly 40% off. You know it's a high-quality brand, and you know that price is a steal. You grab it, right? Of course! You're not just buying a jacket, you're buying it for less than it's truly worth. That feeling, that smart decision, is the heart and soul of the value factor in investing. It's a systematic search for good companies that the market has, for whatever reason, put on the discount rack. It's the ultimate bargain hunt.
Now, how about picking a new TV series? There are thousands of options out there. So what do? You'll probably check the reviews, see what's trending, what everyone is talking about. You're jumping on a show that already has buzz, that has a track record of being great. You're tapping into a trend. And that's exactly what the momentum factor is. It's the idea that winners tend to keep on winning. It's buying stocks that have strong recent performance, based on the belief that that upward trend is likely to continue. The trend, as they say, is your friend. All right, let's get practical. Imagine you're buying new tires for your car. This is a big deal, right? It's about safety. You're not just going to grab the cheapest option you can find. No way. You're going to look at the safety ratings, the durability, the brand's reputation for reliability. You are investing in quality. And the quality factor in the stock market is exactly the same. It's about looking for those financially healthy, stable, well-run companies, the kinds of businesses that are built to last, come rain or shine.
See what I mean? Value, momentum, quality, these aren't some weird abstract financial terms. They're just fancy words for principles you're already using every single day. So let's break them down a bit more. We'll start with the one we all love to find: value. The art of being a bargain hunter.
At its core, value investing is about being a contrarian. It's about looking at a pile of stocks that the market has tossed aside and having the guts to sift through it, looking for treasure. A value investor believes that the market gets emotional. It panics, it gets greedy, it overlooks things, but they believe that over the long run, the true, fundamental worth of a good business will always win out. It really is a game of patience and conviction. It's about buying when everyone else is scared and selling when they get a little too comfortable. So, how do you actually find these supposed bargains? Well, value investors have a whole toolkit, but two of the biggest tools are simple ratios. First, you've got the price-to-earnings ratio, or PE. This just tells you how much you're paying for $1 of a company's profit. A lower number is generally better. It's cheaper. Then there's the price-to-book ratio, or PB. This compares the company's stock price to all its assets minus its debts. If that number's below 1, it means you could theoretically buy the company for less than its assets are worth. Now that's a potential bargain. But, and this is a huge but, you have to be careful of the dreaded value trap. You see, sometimes a stock is cheap for a damn good reason. The company's business model might be broken, their technology might be totally obsolete, or maybe management is just running the place into the ground. In that case, a low price isn't a bargain, it's a red flag. The real skill of a value investor is telling the difference between a true diamond in the rough and a ship that's already taking on water. Okay, let's do a complete 180. We're going to switch gears from the patient, careful bargain hunter and step into the fast-paced world of the trend follower. Let's talk about the momentum factor. If value is buy low, sell high, momentum basically flips that on its head. It's all about buy high and sell even higher. This whole strategy is really based on human psychology. Think about it. Good news about a company comes out, but people are often slow to react, so the price starts to drift up. Then other people see the price rising. They get FOMO, fear of missing out, and they jump in, which pushes the price even higher. It becomes this self-fulfilling prophecy, for a while at least. So how do you actually measure this? Well, one of the most common methods is called the 12 one-month rule. Here's how it works. You look at how a stock has performed over the last 12 months. But, and here's the secret sauce, you completely ignore the most recent month. Why would you do that? Well, because stocks that have a crazy, massive spike in just the last few weeks often tend to crash and burn just as fast. By ignoring that recent noise and focusing on the smoother, more established trend of the prior 11 months, you're more likely to catch a real wave instead of just a temporary splash. But here's the scary part. That wave you're riding, it can crash, and it can crash hard. The number one danger in momentum investing is the momentum crash. This is when the market suddenly reverses, and last year's high-flying winners become this year's biggest losers, almost overnight. It's brutal. And on top of that, because this strategy involves a lot of buying and selling to keep up with the trends, you can get eaten alive by transaction costs and taxes. It is absolutely a high-stakes game, and it's definitely not for the faint of heart. Okay, so we've talked about buying cheap stocks and we've talked about buying hot stocks. Now, let's talk about simply buying the best stocks. This brings us to our third factor, quality. This is all about investing in the best-in-class companies out there.
Quality investing is about being a business analyst, not just a stock picker. You're looking past the daily wiggles of the stock price and focusing on the fundamental health of the company itself. You're not trying to find a bargain. You're not chasing a trend. You are trying to identify those incredible businesses that are just built to last. These are the companies with a powerful brand, consistent profits, and a leadership team that just gets it.
So what's on the checklist for a quality company? Well, there are a few key things. First, high profitability. A good measure for this is return on equity, which basically shows how good the company is at making money with the money investors have given it. Second, you want stable and consistent earnings growth. No crazy up and down roller coasters. And maybe most important of all, low debt. A company with low debt has a fortress-like balance sheet. It means they can survive pretty much any economic storm that comes their way. But of course, there is a catch. Everybody knows these companies are great. They're the blue chips, the household names. And because everyone wants to own them, their stocks are often expensive. They trade at a premium. And this is the biggest risk for a quality investor, overpaying. You have to remember, a wonderful company bought at a terrible price can still be a terrible investment. The real goal here is to find these incredible businesses at a fair price, not just any price. So, we've looked at value, momentum, and quality, each on their own. We've got the bargain hunter, the trend follower, and the best-in-class seeker. But here's where it gets really interesting. The real magic, the real power, happens when you start to bring them all together. Look, no single factor works all the time. It just doesn't. Value tends to do really well coming out of a recession. Momentum often crushes it in a strong, trending bull market. And quality can be a safe place to hide when things get choppy. So by combining them, by not putting all your eggs in one basket, you can build a more resilient, what they call an all-weather portfolio, something that's designed to do reasonably well no matter what the market environment looks like. A multi-factor approach is all about diversifying your strategy, not just your stocks. Instead of making one big bet that, say, value stocks are going to be the winner for the next decade, you're building a portfolio that has multiple engines driving it forward. It's just a much more robust and, frankly, more reliable way to navigate the markets over the long haul. And the combination of value and momentum is probably the perfect example of why this works so well. I mean, they're polar opposites. Value is buying the stuff nobody wants. Momentum is buying the stuff everybody wants. They're fundamentally at odds with each other. And because of that, when one strategy is struggling, the other is often doing great. It's this beautiful 1-2 punch that can really smooth out the ride and lower your portfolio's overall risk. But even if you have the perfect mix of factors, there's one thing you absolutely must have: discipline. This number on the screen, 13 years. From 2007 all the way to 2020, the value factor just didn't work. It underperformed the market so badly that people were writing articles declaring that value investing was officially dead. And then it came roaring back. This is such a powerful lesson. Factors are long-term strategies. They are not get-rich-quick schemes. You have to have the stomach to stick with them, even through years when they're not working. And that really gets to the core of it all. This isn't about having a crystal ball. It's not about predicting what the hot stock is going to be next month. Factor investing is about playing the long game. It's about systematically, patiently, and consistently tilting the odds in your favor, year after year, decade after decade. It is a marathon, not a sprint. So, let's bring this all back to where we started, with you. Now that you see these patterns, the patient bargain hunter, the savvy trend follower, the prudent quality seeker, which one sounds most like you? Which one reflects how you already make decisions in your own life? Because understanding your own style is the absolute best place to start when building an investment strategy that you can actually stick with for the long run. Thanks for joining us today. We'll see you next time.